Hey everyone, how's it going? Jason from accountingshit.com. We're rebranding. We're gonna make this get so much attention. But accountingshit.com is all about accounting. Today we are looking at the balance sheet. The balance sheet. Are we doing our accounting correctly? Are we getting all our numbers right? Are they assets and liabilities adding up? Well, hopefully, because if not, we're doing something wrong. So, and we're going to check out a real example of how a balance sheet works. We're going to look at the Disney company. Well, it's actually a company stock I own. So, anyway, let's get on it. What is the balance sheet? So the balance sheet has the assets, the liabilities, and the owner's equity. And what it's going to do is look at each account. It's going to say, okay, how much assets do you have? How much liabilities do you have? Your accounts payable. How much owner's equity, so your capital, and your assets, of course, are your cash and your equipment and your supplies and XYZ. And it's going to take the assets. It's going to go, okay, plus, plus, plus. This is the total. It's going to take the liabilities and the owner's equity, liabilities and owner's equity, not separate in the credit side. It's going to add those two up and see if they match the assets. And here's a practical example. So we have cash at $83,000. We got supplies at $1,500. We got equipment at $11,000. Remember, we bought equipment on accounts payable and we paid some of that off. So our total assets, all these, equal up to $103,500. Our liability side, we have the $3,500 in accounts payable that we still owe, and we have the equity. So the capital is still $100,000 because we have all that. Still equals $100,000. The capital and the accounts payable equal 103. So you can see 103,500. Assets equal liabilities. Debits equal credits. Remember that. Debits equal credits, and it always has to be this way. If one of these, if this is like 102,500 and this is 103,500, you know you've done something wrong over here. There's $1,000 missing, or you've calculated incorrectly. You need to go back and fix that. So this always has to equal. Assets always equal liabilities. And that's how you know it's correct. Now we're going to take a look here. And let me get this set up for you. At Disney Company. Alright, so this is on MarketWatch.com, the Walt Disney Company. And this is their balance sheet. Now their financials are public information because they are publicly traded. So any company on the stock market, you can see their financials. You can see cash flow statements. You can see the income statement, net cash flow. You can see everything, where they've lost, where they gained. But today we're going to be looking at the balance sheet. So we have cash, accounts receivable. See, they're going to have a longer balance sheet, but they're a bigger company. Accounts receivable are assets. That's money people owe you. Accounts payable is money you owe people or businesses. They write off bad debts. They have inventory. So, you know, this is how many Mickey Mouse costumes they have. Raw materials, I don't think they're doing any building of anything, so they really don't have anything there. That's all zeroed out. Other current assets, I guess, can be assets not otherwise classified, miscellaneous. Total current assets, 14.12. So you have your plant equipment. Here's property. Remember, like the supplies and the equipment that we have. Buildings, land improvement, computers and software. I'm sure they mix that in somewhere else. Other property and plants equipment, 38 billion. You go through long-term note receivables, investments, blah, 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 blah. Total assets, 84.19 billion. Now here's your liabilities and shareholders' equity. Now remember, I said liabilities and equity are added to get to this number. So, you know, they got debt, they got short-term debt, accounts payable. Remember, we had that too, income tax payable. Dividends, because they are a A publicly traded company, they pay out dividends. So to me as a shareholder, they owe me X amount of the profit they make. And they figure all that out. Long-term debts, they got leases, lease obligations, because the mouse has to lease his house, because if he doesn't pay his house, he's going to be kicked out. Taxes, other liabilities. So 3601 in liabilities, and that's in the billions. And here's your equities: preferred stock, common equity, common stocks. That's kind of where I sit right now. You can see they've had some losses. Treasury stock. Here's the shareholders' equity, and the equity equals 8419 billion, which equals 8419 billion. So the assets equal the liabilities and the equity, and liabilities shareholders' equity. You can see at the bottom. So it has to equal out. If this number wasn't equal to this number, it would be a big problem with the SEC. So I'm glad I could give you that real world example. But yeah, your balance sheet is going to be checking if your accounting is correct. So stay tuned. We're going to get into the income statement. We're going to get into the cash flow statement. And then we're going to have some real fun after that. Alright, so this is Jason with accountingshit.com. Thanks for listening.